In light of the recent interview by Michael Lewis on the perils of HFT for one's marketplace, an interesting question is, what is the extent of HFT in Asia Pacific markets? In this video, I'm going to use the market quality dashboard to gather evidence on this topic. The short answer to this question is that it is impossible at the moment to make any definitive statements about the impact of HFT because trading data in most of the major markets of the world does not contain information on who's trading. Without knowing this, we can't connect orders to trades and therefore cannot work out how fast individual traders are trading and when they get faster in order to ask the question, how have they got faster? If they are getting faster because they are reducing risk and compliance checks, then some HFTs, in particular those that have limited or no capital, who have incentives to get faster in order to compensate for a lack of capital, have the ability to blow up the market and undermine investor confidence. Notwithstanding the inability to identify HFTs directly, we can get a sense of the extent of HFT activity in a marketplace by looking at the order-to-trade ratio, which tends to be higher in markets with higher HFT activity. Using the order-to-trade ratio then, I choose three markets from this region, namely the Australian Securities Exchange, the Hong Kong Stock Exchange, and the Tokyo Stock Exchange. Alongside these, I will choose the London Stock Exchange and the Paris Exchange, as well as the Toronto Stock Exchange. I will look across a couple of years of data beginning in 2011 and ending in 2012. As you can plainly see, HFT as proxied by the order-to-trade ratio is nothing like the issue it is in other parts of the world. Order-to-trade ratios are between 3 and 5 to 1, compared to 4 and 5 times that ratio for the comparative markets in Europe and North America. Why is that then? Well, in part, it's because we have things like stamp duties and messaging taxes, as in Australia, Hong Kong and India. Incidentally, that explains why you see the major change in the order-to-trade ratio in Australia in January 2012. If I remove the comparator markets in Europe and North America and zoom in around January 2012, you can see a major change in the Australian marketplace at that time. If I tick on the market design change or events column in Australia and zoom in again, you will see event 17, which was the introduction of the market supervision and competition cost recovery, aka messaging tax. It clearly has a significant impact, or clearly had a significant impact. A second reason why HFT is not as much of an issue as it is in other parts of the world is that in general Asia Pacific markets are too small to sustain more than 2 to 3 competitors, so that differences in latency across exchanges is nowhere near the issue it is in the US and European markets, in turn reducing the need for HFT players to arbitrage prices across those markets.